Hello again. Today we are going to continue on in Module 3-3. We are looking at pay and taxes and how taxes impact your overall earnings and salary. So we're going to get to slide 3 here to start. It says we want to answer these questions as we go through this lesson. Why do you not get all of your pay? How are your payroll taxes actually calculated? And do you have any control over your net pay? So you may recall we talked about net pay versus gross pay. Net pay is what you actually get to keep and take home with you. So it's also referred to as take-home pay, where gross pay is how much money you've made before any taxes or deductions are taken out. Okay, so our whole goal is to be able to maximize your pay options. Income taxes. Depending where you live, there are different types of taxes that you will have to pay. So we have 3 different types of taxes here. We have federal, state, and local. So as an example for us, federal tax would go to pay for things with the national United States government. That's federal. Whenever you hear federal, FBI, the Federal Bureau of Investigation, that's like the government, the U.S. government's agency. So federal means the government as a whole. State, depending what state you live in, like Nebraska, we do have a state tax. So every time I get paid, money goes to the government in the form of federal tax. Money goes to the state of Nebraska. And then depending what city you live in, you may also have a local income tax that goes to your these forms of government kind of go down in stages. So federal's at the top, then we have state, and then we might possibly have a local tax as well to help pay for things within the city that you live in. So here it says taxable income is your gross pay minus any pre-tax deductions. So when I get paid, or when you get paid someday, there might be some forms of your paycheck that can actually be deducted out before tax is taken out. So a good example of this is retirement. If you're saving for retirement at your job, and let's say you take $200 out of every paycheck, and as soon as you get paid, $200 is pulled out and it's put into your retirement plan, you don't get taxed on that $200. So it's a great benefit because you are saving $200 for your future when you're done working, but you're also not having to pay taxes on that at that point in your life. So planning for the future, yes, the amount of money you get to keep and that you get to take out and spend for whatever you want, that's less because you've saved or taken some money out for retirement. Sustainability issues today. So we're going to look at how companies are... Sorry about that. Another video is playing, no worries. So anyway, if you put money into retirement, you have less money to spend within that paycheck right then and there, but you now have $200 less that's going to be contributed to could be contributed to your taxes. So that's a big benefit for you when saving money in that way. All right, Social Security and Medicare. These are services that our country has that are put in place to try and take care of you in the future. And when you pay into it, you'll be able to take money out of it eventually. But it's also to help take care of others when they've reached a form or a stage in their life where they may not be working any longer. So Social Security is basically seen as this giant bank account, if you want to look at it that way, where you pay into it your whole life. Once you reach a certain age, and that age level may change, reason that number might change is because of how many people are retired or not retired, It could also be because of life expectancy. And if people are living longer, they may make that age, they may bump it back to a higher age than it is right now. But basically, this big bank account, you pay into it your whole life. You take a little chunk out of every paycheck you make. You pay into this, and then the idea is that someday you'll reach a point in your life where you can actually take money out of this giant bank account. Um, you've put money into it your whole life. Now it's your turn to have some of that money back. But while you're paying for it as a young person, throughout your life, others are benefiting because they're no longer able to work. They're getting money out of that, but you have to remember they've paid into it their whole life as well, and that's kind of the whole idea of this trust fund. And so we hope it's going to be around for a long time, and that system and that idea continues. It's something that we want to be perpetual, and that's the idea, that it will kind of always be around and kind of fill itself and continue. And as we take out of it, other people will be putting into it, so that everyone gets the benefit from it. Okay, then Medicare, kind of a form of funding for health reasons. It's kind of a type of insurance for people once they reach a certain age. So here we see during the work life, we contribute to Social Security Fund. Sometimes an employer will match your contributions to other funds. So maybe a retirement type of program within your business. That's great. That means you put money into it and your employer basically gives you money up to a certain percentage. At retirement, calculate your average indexed monthly earnings and based on your 35 years of highest earnings. So this all depends what type of system you are in, or how you've saved for your retirement. But they're going to look at your highest years of earning, kind of an average of those, to figure out how much money you'll make during retirement. And then after retirement, it says you can start drawing some of these benefits. And these benefits are going to vary based on how much you put in to these accounts, and kind of your status and your situation. All right, we're going to go ahead and stop there for today.